If you have ever looked at the stock market and thought this feels complicated, you are not alone. Most people see numbers moving up and down on a screen, green arrows, red arrows, news headlines talking about crashes or rallies, but very few people truly understand what is happening behind the scenes. And when something feels confusing, it often feels risky. Today, we are going to change that. We are going to break down how the stock market actually works from the ground up. Not just what it is, but how money moves inside it, how companies use it, how investors make money, and why prices move every single day. Because once you understand the system, it stops feeling like gambling. It starts feeling like structure. My name is Donald, and here on Wealth Clarity, I break down how small financial decisions create massive long-term results. And understanding how the stock market works is one of the most important financial skills you can build. Let's start with the most basic question. What is the stock market? At its core, the stock market is a marketplace. Instead of buying and selling clothes or electronics, people buy and sell ownership in companies. That ownership is called stock. When you buy a share of a company, you are buying a small piece of that business. If the company grows and becomes more valuable, your share becomes more valuable. If the company struggles, your share can lose value. That is the foundation. Now let's go one level deeper. Why do companies sell stock? Companies sell stock to raise money. Imagine a company wants to expand. Maybe it wants to open new locations, build new technology, or hire more employees. It has two main options. It can borrow money or it can sell ownership. When a private company decides to sell shares to the public for the first time, this is called an initial public offering or IPO. During an IPO, shares are offered to investors and the company receives capital in exchange. After that point, the company is publicly traded. This means anyone can buy or sell its shares on a stock exchange. Now let's talk about exchanges. Where do stocks trade? In the United States, stocks primarily trade on major exchanges like the New York Stock Exchange and the NASDAQ. These exchanges are regulated marketplaces. They match buyers and sellers. If you want to buy a stock, there must be someone willing to sell it. If you want to sell, there must be someone willing to buy. The exchange facilitates that transaction. But today, most people do not go directly to the exchange. They use brokerage accounts. Platforms like Fidelity, Charles Schwab, Vanguard, or other brokers allow individual investors to place orders electronically. Now, let's explore what actually moves stock prices. Why do stock prices go up and down? This is where many people get confused. Stock prices move based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. But what influences that demand? Several things. Company performance. If a company reports strong earnings, investors may believe it is growing and want to own it. Economic conditions, interest rates, inflation, employment numbers, and Federal Reserve decisions all affect investor sentiment. News and expectations. Sometimes prices move not because of what happened, but because of what investors expect will happen. And then there is psychology. Markets are driven by human behavior. Fear and greed are powerful forces. When investors feel optimistic, markets tend to rise. When they feel uncertain, markets can fall. Now, let's talk about who participates in the market. Who is actually buying and selling? There are several types of participants. Individual investors. These are everyday people investing through brokerage accounts or retirement accounts. Institutional investors. These include pension funds, mutual funds, hedge funds, and insurance companies. Institutions control large amounts of capital and can move markets significantly. Market makers. Market makers provide liquidity. They continuously offer to buy and sell stocks, helping ensure that trades can happen smoothly. High frequency traders. These firms use algorithms to execute trades in fractions of a second. They profit from tiny price differences at high volume. All of these participants interact constantly. This interaction creates price movement. Now let's address a common misunderstanding. Is the stock market the economy? Not exactly. The stock market reflects expectations about future corporate profits. The economy reflects current economic activity. Sometimes they move together, sometimes they diverge. For example, during times of economic stress, markets may rise if investors believe recovery is coming. The market is forward looking, it prices in expectations. Now let's talk about how investors actually make money. There are two primary ways: capital appreciation. If you buy a stock at $50 and sell it at $70, you make $20 per share. Dividends. Some companies distribute a portion of their profits to shareholders in the form of cash payments. Long-term investors often benefit from both. Now let's introduce index funds. An index fund is a collection of stocks designed to track a specific market index, like the S&P 500. Instead of buying one company, you buy exposure to hundreds. This reduces risk compared to owning a single stock. Historically, broad U.S. market indexes have delivered average annual returns around 7 to 10% over long periods. Not every year, but over decades. This is why long-term investing matters. Now let's talk about volatility. Volatility is the natural up and down movement of prices. Short-term volatility can feel uncomfortable, but it is normal. Markets do not move in straight lines. Over long periods, markets have historically trended upward, but with many corrections and downturns along the way, trying to predict short-term movements is extremely difficult. That is why disciplined, long-term investing often outperforms frequent trading. Now let's discuss risk. All investing carries risk. Stocks can decline in value. Companies can fail. Markets can enter recessions. But diversification reduces individual company risk. Time reduces timing risk. The longer your investment horizon, the more opportunity you have to recover from downturns. Now let's connect this to wealth clarity. The stock market is not a casino. It is a capital allocation system. Companies raise money to grow. Investors provide capital in exchange for ownership. Over time, productive companies generate profits. Profits create value. Value builds wealth. Small investments made consistently can grow substantially over decades. That is how retirement accounts grow. That is how long-term wealth is built. Not through daily predictions, but through disciplined participation in economic growth. Now let's address one more important topic. Why do crashes happen? Crashes happen when fear spreads quickly. Investors rush to sell. Liquidity tightens, prices fall rapidly. Sometimes crashes are triggered by economic events, sometimes by financial bubbles bursting, but historically markets have recovered over time. That does not mean there is no risk. It means markets are cyclical. Understanding that reduces panic. When you understand structure, volatility becomes less emotional. The key takeaway is this: the stock market is a system. Companies raise capital, shares represent ownership. Prices move based on supply and demand. Demand is influenced by performance, expectations, and psychology. Long-term investors benefit from growth and compounding. Short-term traders attempt to profit from price fluctuations. Both exist, but one relies more heavily on patience, and patience is powerful. If this gave you clarity on how the stock market actually works, then you are exactly who Wealth Clarity is for. Here, we do not chase noise. We build understanding, because understanding leads to better decisions, and better decisions repeated over time create massive long-term results. If you found this helpful, consider subscribing, and I will see you in the next video.